Hello everyone, and welcome to another informational video for Closed-End Fund Mastery's Super Screener and Interactive Report. For those of you not familiar with Closed-End Fund Mastery focuses on three primary goals: distribution sustainability, long-term appreciation potential, and being well positioned for future distribution increases and special distributions. To get better acquainted with this powerful tool, I have left some useful links in the description below. And on to the video.
Hello, and welcome back to another informational video on Closed-End Fund Mastery. Today, we're going to take a deep dive into the fund's CLM and CRF. Our primary focus will be on CLM because the concepts discussed apply equally to both funds. But before we delve into that, let me share the topics for the next two upcoming videos. In the next video, I'll be providing a tutorial for the DivX system. In that video, you'll learn how to swiftly import a fund or stock's 5-year history. This feature allows you to examine the past price and dividend performance of securities using DivX and test different DivX scenarios to understand how various multipliers can yield different results. This will help you fine-tune your strategy to help achieve your anticipated desired outcomes using the DivX system. The video after that, I'll be creating a walkthrough video on how to quickly assess whether a fund's distribution might be at risk using CEF Mastery. This applies to all funds, not just CEF Mastery qualifying funds. If you would like to see more videos like this, subscribe below and stay tuned for more valuable content. In this video, we are going to be discussing the mystery behind CLM and CRF's unusually high dividend yields despite what appears to be a never-ending decline in the fund's net asset values. First, we're going to take a brief look at the fund's histories, followed by what makes up a typical distribution. Then we'll look at the fund's rapidly declining net asset value and try to determine what's caused it, but most importantly, can it turn around? Then we will run CLM and CRF through the CEF Mastery Fund Comparison Tool and see if it can give us any indication of what's to come for these two funds. Without further ado, let's jump in. Within the closed-end fund universe, you'll find a handful of sister funds, such as the funds HQH and HQL, RFI, and RQI. The funds CLM and CRF are more than just sisters, they're more like fraternal twins where they don't look exactly alike on the surface, but there's not much difference between them. And for that reason, in the interest of time, we will be focusing much of our attention on CLM. CLM has an inception date going back to 1987. Over the span of more than a decade, CLM was posting some pretty decent gains. It actually looked more like a growth stock than an income fund. Then, at the end of the dot-com bubble in 2000, as was the case with most investment vehicles, CRF included, things took a drastic change for the worse. When the dust settled in 2002, markets began to reverse course and started heading back up again, but not so for CLM or CRF. Something fundamentally changed within both of these funds. I don't know exactly what changed. I tried to find out, but the Securities and Exchange Commission only had reports dating back to the year 2003. Whatever it was, it continued to drag CLM and CRF down even further, even while heading into the great financial crisis of 2007 to 2008, where, just like most securities, got slammed hard again. Now here we are in the year 2024, and yet, while not as aggressive in years past, still CLM and CRF continue their steady descent. So what gives? What is it about this fund that compels people to continue to invest in it? It has to be the high yield, right? Before we look at what makes up the distribution first, let's look at why it's so high in the first place. To do that, we're going to take a look at the fund's distribution policy. Looking at the section highlighted in green, you can see the board of directors again approved a distribution percentage of 21% of net assets for the calendar year 2024. It was again approved, meaning they had a 21% distribution policy the year before as well. That means that at the beginning of the calendar year, for every $100 in net assets held at the end of October, they're going to return $21 of it in distributions, divided evenly among 12 monthly distributions, regardless of how much income the fund actually earns. That's a staggering amount. The mystery of high yield and declining net asset value just got a little less mysterious. Okay, now we want to know how they're going to pay that 21% in net asset value. Ideally, you would want any fund to earn enough income to cover their distributions, plus expenses, irrespective of whether a fund uses return of capital or not. However, to have a portfolio earn enough to cover 21% of a fund's NAV year after year is a very tall order. So, how are they going to do it? Are they going to start selling off assets? Are they planning on winning the lottery? Just how do they intend to do it? The best way to determine how they're going to do it is to examine how they've done it in the past. First, let us look at the most obvious option, net investment income. On the left-hand side of the page, we have the top 10 holdings for the fund CLM, and on the right are the top 10 holdings for the fund CRF. Looking at the top 10 holdings of CLM, on the left you'll notice that I inserted a yield amount for those holdings. These yields are nowhere near sufficient enough to generate an annual yield of 21% plus. If you look at the bottom 4 positions for CRF, they list some pretty decent yielding securities in their top 10, but again, nowhere near the 21% needed. If we head over to the income breakdown chart in closed-end fund mastery, you'll notice at the bottom of the chart, the blue box, which would represent the dividends received from those top 10 holdings we just looked at. If we look at the actual chart, you can't see any blue boxes because the net investment income from those holdings is so insignificant in relation to the shareholder distribution, it doesn't even register. Look at the most recent distribution. For December 2023, net investment income only amounted to $5.7 million of the total $330 million that was paid out. While still looking at this chart, we can see another income option that can help cover the distribution. That is realized gains represented by the maroon box. While in most cases the amount received is still significantly less than the distribution amounts, historically it has been a greater contributor to distribution coverage than net investment income. Next, we have unrealized gains. Now, obviously, unrealized gains cannot be used to pay for a fund's distribution. To do so, you would first have to realize it by selling it, and selling it doesn't necessarily mean it's a gain. It could just as easily be a realized loss. However, even though unrealized gains cannot be used to actually pay the distributions for the fund, unrealized gains could be used to support the distribution, just like the unrealized gain in your home can qualify you for a second mortgage or a refinance, provided there is sufficient equity in the home. We'll touch more on that later. Ironically, when the fund declares their annual 21% of net asset value for distribution, the unrealized gains are included in that net asset value figure, so declining assets could pose a serious problem for the fund during the year. However, by building up its capital base over the last 2 years, and the appreciation of its low-yield, high-growth portfolio, has made CLM healthier today than it was just a couple of years ago. The same goes for CRF as well. We'll explore this more when we look at the funds in the CEF Mastery Super Screener. So now we've established that in almost all cases in the past, net investment income and realized gains have fallen woefully short of covering the fund's distributions. What else can we use? What about reinvested distributions? Paying distributions with reinvested distributions seems a bit far-fetched, doesn't it? Now, I'm not implying that the funds are waiting for dividend reinvestment day to pay the dividend, but issuing paper for new shares in lieu of cash goes a long way. But just how far does it go? On the left, you're looking at the top 10 closed-end funds with the highest reinvestment percentage in relation to the distribution minus return of capital. Initially, I was surprised to see how high the percentages were for all 10 of these funds, and I was particularly shocked at the percentage of the first four funds. If you can't see them, they're ASG, GUD, JQ, and IF. You will also notice within the top 10 are the funds CLM and CRF. In the chart on the right are the top 10 funds reinvestment amounts represented as a percentage of the fund's total net asset value, and not to my surprise, are the fund's CLM in second place and CRF in third. Now, if we go back to the chart on the left, let's visualize what CLM's distribution reinvestment contribution looks like in relation to its total distribution. On the closed-end fund mastery fund flows chart, you have a graphical representation of all the fund's inflows and outflows for the period. If you notice the thick blue translucent bar in the center, that represents the fund's total distribution for the period. The top light blue translucent bar represents return of capital, and the bottom darker blue translucent bar represents distributions from earnings. On the far left of the fund flows chart is a thin sliver of blue that I mentioned earlier represents the fund's net investment income, and as you can see, it is considerably insufficient in relation to the overall distribution. Next to that, you have the realized gains. When stacked on top of net investment income, it pretty much covers the distribution from earnings portion of the distribution. Stacked on top of realized gains is distributions reinvested. If there were a rights offering during the period, which CLM and CRF are known to frequently do, the proceeds received from that transaction would be stacked on top of distribution reinvestments over here. Now going back to the distribution reinvestment percentage chart where I showed you that CLM's reinvested distributions represented 94.01% of CLM's distributions from earnings. If this green block were standing alone, it would account for 94.01% of the darker blue translucent box, which is distributions from earnings. So, in summary, it is quite apparent that distribution reinvestments play a significant role in helping CLM and CRF make their distributions. Now, before we move on to the final piece of the puzzle, let's look at why CLM's distribution reinvestment plan is so popular. It's probably just the cynic in me, but when you read the last part of the plan, you can almost see the wink wink in this last sentence. When the fund trades at a premium to its NAV, as it has in recent history, stockholders may find, wink wink, that reinvestments through the plan provide potential advantages worth considering. I'm not implying anything, and they're not lying. As you can see, interestingly enough, after the dust settled from the dot-com crash, CLM's shares started trading at a premium. I find it intriguing that at a time when the world is crashing down, investors decided that a fund whose net asset value is nosediving is suddenly worth more than its underlying assets. If I had to speculate as to why, it's because investors started to put a premium on high yield. You can see the same thing happened with GOF after the dust settled from the great financial crisis in 2009. Now for the final and probably the most significant piece of the distribution puzzle, rights offerings. Some people incorrectly assume that closed-end funds are closed, meaning closed to new investors. That may have been the case when closed-end funds arrived back in 1893, but the truth is that just about every closed-end fund trading today has mechanisms in which to introduce new shares to market, and they're available to all investors in some instances, such as shares sold at the market through a third party or an ATM facility. Some methods are exclusive to current shareholders, as is the case with rights offerings. We're not going to go into detail about rights offerings in this video because that's not the topic of this video. Simply put, rights offerings are exclusive offers for shareholders to obtain new shares at net asset value or at a discount to net asset value, and they're quite sizable in relation to the fund's net asset value. Rights offerings are apparently CLM and CRF's preferred mechanism. CLM and CRF started using rights offerings in 2010. Since 2010, CLM has done 7 rights offerings to date, and I believe CRF has done 9. I only went as far back as 2012 with CLM. I created a timeline of CLM's rights offerings over the past many years to see if I could detect a pattern of anything: time interval between offerings, net asset value relation to rights offerings, shareholders' reactions to rights offerings at the time of announcement and the time of completion. I didn't discover anything earth-shattering, but I did find some things of interest. The first thing you notice is that CLM has been making rights offerings almost every year, but there is no consistency in the timing in which they file during the year. So don't set your watch by it in hopes of anticipating when the next rights offering is going to happen. The second noticeable thing is that in September 2014, they filed an intent to execute a rights offering, but it appears they never followed through with it. And in fact, by the end of 2014, they ended up doing a reverse 1-for-4 stock split, taking the share price from $5.71 a share to $20.54 a share. I can't say for certain that what I'm about to tell you is the reason for the reverse stock split, but if you're familiar with using margin in your brokerage account, you'll know that your buying power is greatly affected when shares that you hold drop below $5 a share, because your broker will lend less money against those shares. I'm not saying that's why it was done, but I pointed that out because as of today, CLM shares are trading at only $7.55 a share. The most notable thing, if you look at the chart on the left, you'll notice a steady decline of CLM's net asset value share price, but in the chart on the right, they're raising more and more money and issuing more and more shares with each rights offering. This is significant because if we zoom into the last 5 years for CLM, there have been 2 rights offerings. But if you look at the chart's NAV price per share, there has been no significant bump from the rights offerings. If you look at CLM's balance sheet over the same time frame, those 2 rights offerings have significantly added to their net asset value, not to be confused with net asset value share price. This is major because if you look at the chart on the left, it appears as though CLM is getting weaker and weaker and weaker. But what is really happening is that when CLM executes a rights offering, as I showed earlier in the previous chart, with each filing they're raising more and more money. But because they're issuing those new shares at the prevailing net asset value share price instead of doing a reverse stock split to boost the net asset value share price, it makes CLM look like it's dead in the water. Before we move on to the next segment, the final chart I want to cover is the distribution history. And all I have to say about this is that rights offerings haven't been much of a factor in helping the distributions. Since they started doing rights offerings, there have only been 2 minimal distribution increases. I was hoping to dive a little deeper into the return of capital aspect of this fund, but this video is getting a bit long, so I'll have to do another video on that in the future. Next, we're going to look at CLM and CRF in the CEF Mastery Super Screener and see if these funds are even worth considering. If you are not familiar with CEF Mastery, I'm going to enter 2 additional funds into the fund comparison tool alongside CLM and CRF to give you some perspective of a fund's overall health when compared to other funds. EOS. This is an example of a healthy fund, and it is currently a CEF Mastery qualifying fund. Next is GGT, which is not as healthy as EOS and is not a CEF Mastery qualifying fund. Then we have the stars of the show, CLM and CRF. Almost immediately, I think you can see a contrast among the different funds. We're going to zoom in to get a closer look at CLM and CRF, but feel free to pause the video if you wish to see how they compare to our other 2 examples. I think maybe one misconception that a lot of people have about CLM and CRF, they assume that because of continuous, and in some cases, rather extreme NAV share price declines that the fund must be continuously losing money. Then when you look at the 5-year NAV price change declines in excess of -30%, then this just confirms the suspicion, but this is not the case. If you look at the 3-year and 5-year returns with distributions reinvested, the funds are not losing money. They're just paying out more than they earn, and the reason for the NAV deficits are due to declines in NAV as a result of return of capital over the last 5 years. Quickly moving along, we have the fund's scores as ranked by CEF Mastery. US the clear winner in this case. You can see that CLM and CRF have the same scores because, as I mentioned earlier in the video, there isn't much that separates them from one another, as you're about to see. Both CLM and CRF have high portfolio turnover rates and practically no debt. Under net investment income to distribution, you can see the effect of their low-yielding portfolios. In the column next to that is the addition of realized gains on top of the net investment income. Nearly identical. And finally, we have the combined percentage of all income sources as a percentage of distribution, and thanks to unrealized gains, both funds were able to cover their distributions with some to spare. Both CLM and CRF actually paid out a distribution yield to NAV of 20.9%, just 0.1% shy of the stated 21% in their distribution policies. CLM edged out CRF overall with a reported income in excess of distribution of 4% to 3.6%. Earnings surplus deficit. This is the pool of profit that the fund has accumulated over the life of the fund. Too much to go into in this video. I have outlined what goes into all these fields in great detail and what makes the CEF Mastery Super Screener so super video. The link is in the description below if you want to learn more. This number is the figure CEF Mastery uses to convert their earnings into the equivalent number of monthly distributions available. Finally, we have current performance under the green headers. You can pause here and take a gander. CRF is trading at a bigger premium. As you recall, if you reinvest distributions, this is a bigger discount to market value than CLM. Estimated distribution to NAV, based on reported share count, CEF Mastery estimates that CLM and CRF have come very close to meeting the 21% yield to NAV for the period. And, last of all, the fund's final scores. US is the clear winner, but as it pertains to CLM and CRF, CLM has a slight lead. With only 4 short months to go before CLM and CRF announce their distribution policy for the next calendar year, when you take into account current fund performances and if they can hold on to current unrealized gains, renewing their current 21% distribution policy at the current distribution rate shouldn't be a problem, and that's without the help of new rights offerings. Should there be a distribution rate increase, history shows not to expect much. Of course, everything is at the discretion of fund management. There you have it. I think we've explored just about every aspect of these two funds. If you gained anything from this video, give it a like and feel free to comment below and subscribe. Thanks for watching. Till next time, many happy returns.